good morning, and welcome to the Nedgroup Investments Global Quarterly Roundup. My name is Anil Jugmohan, Senior Investment Analyst here at Nedgroup Investments. Q1 was a difficult one. Can you believe it? The MSCI World Index was down almost 2%, but that actually pales in comparison to all the volatility that we've seen over the past 3 weeks or so. Joining me first for today, we have Mike Moore. Mike is a portfolio manager at Veritas Asset Management. They manage the Nedgroup Investments Global Equity Fund. Mike, very warm welcome to you.
Morning.
Great, thanks so much for joining us. So, Mike, I've got a few questions for you. As I just mentioned to our audience, it was a pretty rough quarter in Q1, and the MSCI World Index was down a little bit, but at least the fund actually fared pretty well during that period. Can we please start by talking through performance, please?
Yeah, sure. So in terms of the 3-month performance, the fund was up 1.3% versus the MSCI World Index down 1.8%. We do focus on absolute returns, and so the CPI plus 6 was up 2.43%. I'd say the kind of the key drivers of that is actually we have a relatively sort of defensive and durable companies within the portfolio, and those did relatively well. Also, some of the kind of, I'd say more of the sort of high-flying stocks, there was a sentiment shift in the first quarter into a strong period of performance there, so that also benefited us. On a 1-year basis, we still lag the MSCI World Index at 7% versus 4.3% for the fund, and the CPI plus 6% target that we set of 8.86%. But we do think that going forward, given what we think will be a volatile economic environment, that we have a very good roster and portfolio of companies that are durable and can adapt to the economic circumstances going forward.
Thanks, Mike. And just maybe drilling a little bit deeper into how you achieve those returns, can we please look at attribution analysis, please, perhaps over the last quarter and the past year as well?
Sure. So I'll start off in with the last quarter. So industrials was a 2.9% benefit. That was led primarily by European industrials positions. Another area that was actually maybe a surprising positive was consumer discretionary, Amazon, Richemont, and we have another company called Amadeus. In travel software, which is an information technology style business, but in the consumer discretionary sector. They all contributed to that performance. And also in terms of the information technology sector, obviously that has been a strong performer, and obviously the sentiment somewhat changed for some of the high-flying stocks in that sector of the market. We have got exposure there, but our information technology positions are more broad and widespread across the other sectors. So, for example, Amazon is in consumer discretionary, and Alphabet is in communication services. In terms of sort of the detractors, Diageo was a detractor given the I say concerns about sort of tariff impacts. It's a spirits maker that sells into the US. We do think that is overstated, but that obviously had an impact on the company. And then in healthcare, it was sort of mixed performance. Some of the companies didn't perform as well, but there are green shoots in their end markets, and then some of the positions such as Elevance have done relatively well in United Health in the first quarter of the year. Over the 12-month period, the consumer discretionary was positive 1.3%, and that was led by the same companies, and was a key positive. Industrials was a 0.2% positive, but that was held back by Canadian Pacific, which is a North American railroad company, and they obviously been sort of, again, there have been question marks in terms of the tariff impacts. Again, we think that they are relatively well insulated to some of those impacts, and it's more than reflected in the price today. And in terms of the other aspects, communication services was a positive, with Charter actually contributing 0.6% performance over the 12 months, as some of the kind of the headwinds that the company's faced over the last couple of years have started to unwind, and obviously it has a pretty defensive, durable profile as well. The chief two lags were sort of the chief three lags were Diageo for the reasons that I've described there. Healthcare has been sort of a challenging sector for a period now. We do maintain our conviction in the healthcare positions, and actually we are starting to see some green shoots in the last quarter and some sort of better performance from those companies. And then also cash and equivalents was a drag, whereas over the last 12 months, that's about a 5% position. At the end of March, it was around 7.5%, and that's because we'd actually be selling down some of the positions as the valuations became more stretched. But going forward, we do think we've got a very durable set of businesses that can manage the current sort of economic volatility that we're seeing.
Thanks, Mike. Yeah, I think that's very important about the durability of the businesses and I think the quality of the companies that you invest in. It's always something that helps with sustainability of absolute returns. And then, Mike, just very quickly, I think on my data, it doesn't seem like there were any buyers or sells over the quarter. Is that right?
Yes, that is correct. Now, there's a couple of points to make here. The first one is into the end of 2024, we'd actually seen the cash levels rise towards 9%, and then actually that's actually reduced in Q1. So we were actually adding to existing positions during that period where we saw opportunities. I'd say going into beyond March and into this quarter, we have continued to modestly deploy capital. So we've been sort of very conscious of how we do that. But we've actually added another position that should come. That we'll discuss in the next quarterly announcement, but we have been active in starting to deploy capital where we've seen asymmetric risk rewards on an absolute return basis. So we are starting to see opportunities, but because of the current sort of lack of visibility, we're being quite measured in how we're doing that at the moment.
Yeah, I think that's important, being measured in your approach and just tactically tweaking the portfolio as you see fit. And Mike, I guess just maybe a good time to just do a high-level overview of the portfolio, please. I think probably a good time for that.
Yeah, sure. So I think there are a couple of things I'd say draw out, and the first one is actually if you look back probably 18 months ago, the skew to North America would have been significantly higher, but as valuations have got relatively higher in those markets, we've actually found more opportunities further afield, and so actually now around sort of 37% of the portfolio is in sort of wider Europe, as it were. And so that isn't a conscious decision to go to kind of Europe per se. It's more because that's where we've been finding opportunities and value in terms of the positions. And so that's something to call out, I think. In terms of the sector positioning, we have industrials at 24%. That has been that is really unchanged in terms of the most the most significant sector, although we have trimmed some of the positions there over the year as some of those companies have done relatively well. Healthcare remains a strong theme within the portfolio and at 20%. And I'd say here one point to call out on information technologies, although it's 11% there, like I said, that's expressed in other sectors, so communication services with Alphabet, for example. And so what we would consider to be sort of those technology positions are much more similar in quantum to the industrials and healthcare sector overall. Like I said, the cash level is at 7.5% at the end of the quarter, but we have been sort of, like I say, cautiously deploying capital where we've seen opportunities. And in terms of the top 10 holdings, we have reasonably defensive positions in companies like Aon, which is kind of insurance broking, United Health, which is health insurance. We've got consumer staples like Unilever in there, and even in some of the more cyclical type businesses like Microsoft. There is a strong recurring revenue and annuity stream in those areas as well. So we do feel like we're well positioned to weather any sort of, like I say, volatility in the economic landscape, and we do have businesses that we think are quite adaptable to whatever is thrown at them.
Yeah, thanks, Mike. I mean, I definitely did notice that North America position changing, and obviously you're doing all the work from a bottom-up perspective and making sure that the quality of the companies and sustainability of cash flows is there. So yeah, just an interesting move in the portfolio. But now that you have taken us through some of the details of the portfolio, do you mind maybe sharing your perspective on what you saw coming into the start of the year, please?
Yeah, I think the context at the end of 2024 is really important, and just to frame where we are now and where we were at the end of the year. So, in the top left-hand chart, this is the cyclically adjusted PE over the last 50 years, and you can see it as we went into the end of the year. That was at the kind of the third highest point over that time period. You know, the PE of the S&P was in the kind of the low 20s. And if you look at the bottom left-hand chart, it was the second strongest S&P return in a presidential year since 1936. So there was a lot of sort of positivity in the market, and you know, for some understandable reasons. So the Trump first term had seen sort of things like tax cuts, expansionary economic policy, stock markets did relatively well. And so at the turn of the year, there was kind of a cause for optimism, and some of the valuations had stretched. I think one of the interesting things to draw out for investors is just, if you'd have asked somebody, I think, or you know, the average investor, what they thought would have probably worked in 2025, they may have said to you, well, actually, you know, the US outperformance continues, and you know, the growth, those kind of growth matrix type stocks continue to outperform. What we've actually seen is pretty much the opposite of, you know, Europe outperforming and kind of value returning into focus. And so I think it is also, you know, it is interesting to sort of see that dynamic change, and you know, there's some sort of lethargy with some of the performance of some of the, you know, the very fast rising stocks. I think in terms of this slide, the other thing to note is just the real cyclically adjusted earnings yield premium, and that's a mouthful, but what that really is the inflation adjusted excess yield of the S&P over the 10-year bonds. So it's kind of the excess returns you make for taking the risk of deploying into equities. When that has been relatively low, and that's the yellow line in the chart, then the forward 10-year real returns that have been observed have been either relatively low or negative. So we think whilst there has been a very strong period of performance for the equity markets, we do think that there are signs, you know, from a statistical and a historic perspective, that those returns may be somewhat lower over the medium term. And we do think that actually, historically, the fund has performed well in these types of environments, and that the companies that we look to invest in and our absolute return focus actually tend to do relatively well in those periods. So we think we're reasonably sort of well placed for whatever is thrown at us. In terms of the market, it was expensive. It still is to a degree, obviously. And, you know, our universalist IRR was compressing. So we actually took that cash level up to 9%. We've selectively looked to sort of redeploy some of that where we've seen those opportunities. And that's what you should expect to see us do going forward.
Thanks, Mike. So yeah, market was expensive, capital risk was high, so you were positioned defensively. So I guess it's always the perfect timing for these tariffs. I mean, it's never a good time for volatility, but at least you went in like quite well positioned. So from your side, the potential impact of the tariffs, and you know, what about the retaliatory effects we've been seeing and risk of potential dumping as well? What are you seeing from your side, please?
Yeah, so the first thing I'll say with tariffs is very much an obvious one, but I think you've really got to, you know, it's important to stress it, is that there are significantly more unknowns than knowns at this point in time. I think the second point to also just note is that you know, the fallacy of being able to accurately predict geopolitics and sort of macroeconomics. And so we take a kind of a macro aware approach, but we think trying to call these things is extremely difficult. And I think this period, the last sort of 3 or 4 weeks, goes to prove that. I think one of the things just to sort of draw out is just the quantum of what's being suggested, and also some of those first order impacts that we're potentially seeing. So in the chart that you can see here on the left by UBS, they tried to sort of work out what the effective sort of tariff rate would be. Now, the first thing I'll tell you is that 25.1%, that red line, is not going to be right, because this is moving almost on a daily basis, and that's what tells you that, you know, that tells you something in itself. But this was done before the kind of the hiatus in the tariff application, and then before the kind of the China step up in tariffs as well. But The bigger point about this chart is not that, because, like I say, it's very difficult to call exactly what's going to happen there. So, you should take that with a pinch of salt. The bigger picture is that actually over the very long term, like the last half century, effective tariffs in the US have been sort of mid to low single digits. And so when they're putting these 10% tariffs through on sort of physical goods and these other extra tariffs on top potentially, depending on the geography, these are significant in the context of what has gone before for a long period of time. That's also seconded by the April 2nd tariffs, and I have to put a date on them because these things seem to be moving on a daily basis, but they were estimated to raise around 2.2 trillion over a decade. So these are significant sums and significant impacts. I'd also say that the end goal is somewhat unclear. So in terms of how much of it is ideological, so Donald Trump, what he's doing today, he statements he's made in the long distant past echo some of these sorts. So it is much more long-standing than I think maybe the market participants have sort of factored in. And you can see that from some comments he made about trade policy, took out adverts, and I think in the New York Times in the 1980s, with echoes of what we see today. A lot of people thought this was a negotiation tactic, and I'm sure it is. And there is a strong element to that to get better trade terms from their partners. But again, it's just how much of that is ideological versus something they're willing to sort of deviate from. And so you can see those kind of negotiation tactics, for example, with TikTok potentially being banned in the US, they're trying to bring China to the table to actually potentially find a US seller. The duration is unclear, and you can just see that by the fact that it seems like every day we're getting a potential exemption or a delay, and so there are a lot of unknowns in all this. The one thing that I will draw on, though, is that the direct US tariff impacts are quantifiable. So the first order impacts of what the tariffs will do, you can, to a degree, model that. And although there's a high degree of change in that, you can actually get a reasonable impact of underwriting what's being priced into the companies on that basis. The bigger issue really is the second order impact. So it's kind of the retaliatory actions that they will face. So whether it's China going toe-to-toe on tariffs, whether it's the European Union potentially looking to tax services of the US large tech companies, those secondary sort of retaliatory actions are much more difficult to assess. And I think these are some of the wider issues. Secondly, the potential risk for dumping is pretty high because these China goods that are made, they've got to go somewhere. So that can have ramifications potentially for European, for UK markets, for example. And so there are still a significant amount of unknowns. But being able to quantify those first order effects, I think it is doable. It's hard, but it's doable. But I think it's these second order effects that we really have to watch for.
Yeah, thanks, Mac. I guess it would be no fun if I didn't stop you to ask about those second order effects now. I mean, as if things weren't complicated enough already. But, what about those second order effects? What about the impact to the various sectors and the potential unintended consequences as well, please?
Yeah, so I think this is the bit that is really giving us, a lot of sort of posing us a lot of questions, really, in terms of those secondary impacts. They're much harder to gauge. They're much broader spread. But the thing that I think is really important for watchers to note is they are already impacting, and that's before really we've actually got really into this stuff, as it were, in terms of kind of the actual impacts. And you can see that in the top left-hand chart, US consumer inflation expectations have sharply risen. That's the red line. You can see in the last couple of months. On the right-hand chart, the expected change in financial situation has gone materially down again for the US consumer. So people, from a consumer demand perspective, inflation expectations are higher. Consumer confidence is already lower. There are then follow-on macroeconomic impacts. So if you've got higher inflation and potentially struggling demand, for example, then what do you do with interest rates? Do they come down? Do they stay higher for longer? And this obviously has significant ramifications. For currencies, you've got the dollar is currently depreciating. You've got potentially competitive devaluations elsewhere. It opens up a bit of a Pandora's box of sort of impacts really for on a wider level. And so how does that all fit into sort of business demand? Well, we see that investment retrenchment is somewhat likely. And the complex supply chain ramifications are also, I think, something to keep a keen watch on. And so we've actually spoken to CEOs of companies, and they've spoken to the fact that actually for some of the products, they've got component parts that are going across borders multiple times. And so to actually unpick all this from an operational perspective is very difficult. From an investment retrenchment point of view, just to give a sort of an idea, last week, a Swedish software company called Hexagon actually warned on its Q1 and it cited specifically customer hesitation in North America and also in China. And that's obviously some of the spillover effects that you're already seeing, that it doesn't have to be that direct. And so the risk of unintended consequences here is pretty high. You've got a tariffed end product, what happens to the component manufacturing that goes into that? There's a whole host of things to think about. So from an equity point of view, we do think there are going to be sort of demand pressures. There's, potential for cost inflation. Operational flexibility for each individual company is something you've got to keep a very close watch on, because we do think that there are going to be, really some significant adjustments that are needed by companies. And then we've got to consider those financing constraints as well. So what interest rates are going to do. And then finally, the valuation construct, because, if the risk-free rate's moving, then that does have implications for wider market valuations as well. So what I would tell you is it opens up, a lot of questions, and those impacts are potentially large and hard to gauge. So we do think that it's important to sort of remain cautious and vigilant at this stage.
I mean, Mike, this is really such interesting stuff. I really, would like to delve deeper into the companies in the portfolio and kind of the degree of impact to which they're experiencing, please. Yeah, maybe talk through your positioning there.
Sure. So like I say, we do look for durable businesses and sort of defensive cash flow generative business models. So that's typically what we've always done. And during these periods, we do think that is that is pretty helpful for the strategy. At a high level, when we're looking for any company, we're looking for companies that have durable end markets. One key part of our investment philosophy is the absolute valuation focus that's underpinned by cash flow. So we have that across our companies. Conservative financing. The one that I will draw out, and I think is possibly the most important, is actually having competitively advantaged companies with pricing power. And we think that's really going to be important when it comes to tariffs and passing on costs and any inflationary pressure there. Like I said, we've got reasonable non-US exposure, and that's been in part sort of driven by kind of the bottom-up stock picking and valuations. And we also look for companies with strong management teams that can capital allocate well and navigate a path through what is going to be, a tricky economic climate. In the bottom half of the chart, we've actually put together sort of 4 buckets of the kind of the impact, and obviously these may sort of slightly change over time. But we have sort of no direct impact, limited impact, modest, and most impacted. On the no direct impact side, these are businesses where we think there is pretty de minimis potential impact from tariffs, so it's very manageable. On the limited companies, largely these are companies that are service businesses that aren't sort of captured by tariffs. Then there's a modest impact, which is companies that are product businesses, but they do have offsets and strong pricing power. And then finally, we have the most impacted side, where we've done sort of a lot of work to size potential impacts. And even within this sort of sector of companies, we find that the actual first order impacts are only kind of in the mid-single digit range of hit to profitability. And so, these are more your kind of classic Amazon, Chinese suppliers, Diageo, selling products, say, for tequila into the US markets. But we do think that even there it's nuanced. So if I take Amazon as an example, 60% of its profitability today is actually driven by its AWS, its cloud computing business, where we still see that as having very strong fundamentals, and it's an advantage business. The other point that I would make is some of the rule changes about what can be shipped direct from China do impair some of Amazon's competitors, so Shein and Temu, which have sort of been considered a kind of a longer term competitive threat. And so that actually is a positive for Amazon. And then finally, around sort of 2/3 of Amazon's sort of merchandise value that goes through its platform is actually done on a third-party basis. So that's sellers selling on Amazon's platform. And so when they put prices up, Amazon get a percentage of that take rate. So it insulates them against those price rises to a degree. but also, there is going to be a demand impact there as well. So when we look at those, we do think there are nuances and things to consider that are offsets. But overall, we're focusing on the companies with durable end markets. We've got that absolute valuation focus with strong free cash flow backing, and companies that have strong pricing power with good management teams. And we think those factors will allow these companies to excel in a period which is going to be difficult. And like I say, from a macro perspective, it's very difficult to call, but we think these companies have a very strong chance of being able to outcompete competitors and actually perform very well over a period where whatever will be thrown at them remains unclear.
Mike, that was perfect. Thank you very much. I mean, we can literally end up talking about this the whole day. But we really appreciate your time and all your insights, and really appreciate what you and the team are doing to protect investors' capital. Thank you so much.
Great. Thank you.